Hello, and welcome to the presentation on how spread betting works. What is spread betting? Spread betting offers you the opportunity to trade shares, indices, forex, and commodities and profit from a rising or falling market, whilst initially only paying a fraction of the total cost. You can do all this from one account on a single platform. In contrast, some traditional stockbrokers make you use different platforms or might charge you an extra fee for dealing in international shares. When you spread bet, you are not really buying or selling the underlying physical asset, for instance, Ryanair shares or gold. You are simply betting on the direction in which you believe the underlying physical asset will move. The only cost involved with spread betting amounts to the spread, which is the difference between the buying and the selling price. With spread betting, you place a buy bet if you believe the market is going to rise, or a sell bet if you believe the market is going to fall. The profit or loss you make depends on the movement of the market relative to your bet. How spread betting works. 1. Know your spread. The spread betting provider will quote you two prices for any underlying instrument, for example, shares, indices, or currencies. The lower selling price is referred to as the bid, and the higher buying price is called the offer. The difference between these two is called the spread. Example: the spread betting provider quotes 346 to 347 for Marks and Spencer. 346 is the sell or bid price. 347 is the buy or the offer price. 2. Decide which way you want to bet. If you believe prices will rise, you place a buy bet. And if you believe prices will fall, you place a sell bet. Example: if you think prices will rise, you bet that Marks and Spencer shares will move higher than 347. If you think prices will fall, you bet that the Marks and Spencer share price will move lower than 346. 3. Decide how much you want to bet per point. The movement of the underlying shares or index is measured in points. For every point up or down, you can choose to bet an amount. Example: you decide to bet £30 per point at 347. With this bet, you make £30 for every point that the bid price, the price at which you can close the position, rises above 347, and lose £30 for every point the bid price falls below 346. 4. Closing your bet and calculating your return. To close the bet, you simply place an opposite bet for the same amount per point. Example: after 1 week, the Marks and Spencer share price has risen to 372 to 373, and you decide to take your profit. You close your bet by selling £30 point at 372, the bid price. You have made 372 minus 347 at £30, which equals £750. And with no tax to pay. Of course, had the price moved against you, you could have lost more than your initial deposit.